of more rate hikes ahead in the next text for the markets. That's just coming up next week. Joining me for the hour, all-star panel here, Shannon Saccocia, Michael Farr, Jason Snipe, and Steve Weiss. Let's start with the moment of truth for the consumer. We're going to hear from some big retailers next week, the results, the guidance, and much more. Jason, the retail report was strong on Wednesday, but now we have the possibility of the Fed staying engaged for longer, maybe, just maybe, a 50 basis point hike at the next meeting. You own Target and Home Depot. What are your expectations?
Yeah, so I would say this, Frank. Obviously, we've seen the consumer's resiliency over the last year and some change. And with the Fed that's been very much engaged. With a retail's report that was blowout numbers, almost twice what consensus believed it would be, and PPI numbers up 0.7, so above consensus, and a CPI number that was relatively muted. It wasn't hot, but it also wasn't some of the real deceleration that we've seen. Still up about 0.5 on the headline level. So for me, as I look to the retailers next week, Target, Walmart, some of these names, I do think that we'll continue to see some steady growth. I mean, for a lot of these folks, it's been an inventory issue, and trying to manage through that over the last couple of quarters. And I do believe that story is somewhat behind them. There might be another quarter to see this issue, but I do think margins will start to improve. But we are seeing trade down. I mean, the consumer is conscious of prices going forward. So, for me, we're relatively neutral on a lot of these retail names, and we'll look to put them in review in Q2 of this year and whether we're going to unload them or not. All
right, relatively neutral there. Shannon, you have a lot of retail exposure as well, Home Depot, Costco, and Best Buy. What's your take on what you're expecting for next week?
Well, we're at least, in terms of for next week, thinking about the potential for some moderation in same-store sales growth, particularly for Home Depot. A little bit of a concern about full-year sales. We've benefited in the retail space from a higher ticket, right, due to inflation. And the challenge is that if you look at Home Depot, for instance, last quarter, they actually had lower transactions. And so even though they beat, it was really on those higher ticket costs. And so I think one of the things that we really need to take a step back and say, what's changed in the landscape over the course of the last couple of weeks? We obviously had a hotter than anticipated CPI and PPI print. But I think that we're still continuing to see a disinflationary trend. And I think that is critical. The piece is how resilient can the consumer remain when the savings rate is down significantly from where we were a year ago and certainly from 2 years ago. And I think that this is where you're going to start to see some divergence, Frank, in terms of the consumer discretionary space. Will there be some trade down? Will consumers look at their basket, which has already been stretched, frankly, over the course of the last year due to inflation? Are they going to look at spending that differently? I think the retail sales number was very strong, but we saw a similar uptick last year as well in January. And so I would caution that I think there's more of a story here than just in or out of the consumer. I think it's where you're in the consumer space that's really going to be important through the rest of the year.
You hit on something, Shannon, we talk about a lot on this show and on other shows here on CNBC, the divergence between the consumer and the market. Note out from Apollo today, that kind of ties the two together. It says in part, higher interest rates for longer is negative for consumer spending, CapEx, and corporate earnings. In short, under the no landing scenario, the Fed is not done raising rates, which means that the trading environment from 2022 will be coming back. So during 2022, we saw a tough trading environment, but really strong consumer, Michael Farr. So do you believe that these rising rates, is that finally going to slow down the U.S. consumer?
Well, that's the whole point. I mean, right, we've got a lower demand. They really can't, as the Federal Reserve can't affect the supply chain issues, so they're going to go and try and curtail demand, and they've been trying. But when you look at the consumer, Frank, think about the gas in the tank, the financial gas in the tank of the consumer over time. And you heard Shannon and Jason both say that the savings rate is down. The other thing is credit card balances have rocketed. So the consumer is running out of wallet. They still have savings that I think can probably last through the summer, pent up from a lot of checks and savings through the pandemic and government checks and other things that are out there. They are still spending, right? Resiliently spending because they feel good. There's more money in the consumer's check. And if the consumer feels good in the U.S., they spend. 2/3 of our GDP is driven by this consumer. So you have to pay attention to how much gas is in the tank. A little more money from Social Security, 8% increase, right, in the cost of living, COLA adjustment for Social Security, a little more money in the checks. The more money in the checks, additionally, is not keeping up with the increased prices of stuff that the consumer has to buy, rents and everything else. So I see the consumer getting more and more squeezed, and the attitude really has yet to change. So I'm cautious on the consumer as we go out into the second quarter, as Jason said earlier. And I think you have to be cautious, which more reason to look, if you're going to own this space, these companies with really good balance sheets, earnings, cash flow, and some experienced management.